A Chinese tea brand goes public on Nasdaq, not selling bottled drinks, not riding take-up cycles, just tea, brewed to order, served in sleek, digital-first stores, app-powered, and built for fast pickup. That's Chagee. Founded in 2017 in Kunming, China, the company has scaled at breakneck speed. As of March 2025, it operates 6,681 tea houses, including 6,512 in Greater China and 169 overseas. That's a net increase of 241 stores in just one quarter. In April 2025, Chagee raised $472.9 million in a US IPO, making it the largest American listing by a Chinese consumer brand in over 3 years. At listing, the company was valued at roughly $6.2 billion. The pitch is simple. Premium tea positioned like a lifestyle product. The brand calls it Teaspresso. Think of it as the tea world's answer to Starbucks. But can this model work outside of China? Let's break it down. Chagee's origin story is built on modernization, but it starts in one of the most traditional tea regions in the world, Yunnan. Founded in 2017 in Kunming, the provincial capital, the company emerged from a place best known for pu'er tea, mountain farms, and centuries-old rituals. But Chagee had no interest in nostalgia. Instead, it reimagined tea for a younger, design-conscious, urban audience. No wooden chairs, no teapots, carefully designed spaces, often minimalist, sometimes immersive, with standardized recipes and pressure-brewed tea served in custom cups. The company was founded by Zhang Junjie, a former marketing executive who saw an opportunity to elevate tea to the status of coffee in modern China. He didn't want to sell tea as a cultural relic, he wanted to sell it like a lifestyle. The first few years were all about speed. By 2020, Chagee had opened over 1,200 stores. By Q1 2025, it had passed 6,600, making it one of the fastest growing tea chains in Asia. This scale is powered not just by branding, but by a tightly integrated digital ecosystem. Orders are placed via Chagee's mobile mini program, which had over 192 million registered members as of March 2025. It tracks behavior, optimizes logistics, and enables precise product launches, all while reinforcing the brand's image as a tech-savvy, modern player. China's freshly brewed tea market has expanded rapidly. Between 2019 and 2024, the segment grew at 21.7% CAGR, one of the fastest in the beverage industry. However, growth is expected to moderate to around 11.8% CAGR in 2024-2028, as the category matures. While Chagee operates in the fastest growing niche, freshly made tea drinks, this growth segment is also the most exposed to new entrants and competitive pressure. Chagee is now among the biggest tea chains in China. Within the peer, shown here, Chagee accounts for around 6% of tea outlets. Mass market giants like Mixue dwarf the rest, and no player is anywhere near a majority. The category is ultra fragmented. When we widen the lens to include coffee heavyweights like Luckin, Starbucks, Coty or Manner, Chagee's slice falls to around 4% of combined outlets, underscoring how fragmented and fiercely competitive China's drinks landscape remains. Despite its sleek stores and strong brand identity, Chagee lacks a real moat. Its product, high-end milk tea, is easy to replicate, and while its branding is polished, it doesn't carry deep cultural or emotional weight. Take Changsha, the hometown of Chaiyan Yuese, where the brand's city icon status and strong local loyalty make it a notoriously hard market for outside chains like Chagee, highlighting the risk from regional champion. This shows how vulnerable Chagee is to regional competition. Moreover, Chagee's heavy reliance on franchising raises consistency concerns. The company provides ingredients and furniture with strict brand guidelines, but actual service quality, cleanliness, and customer experience can still vary across locations. That's the trade-off for scale through franchising. Now, what makes the business particularly scalable is its franchise-first model. Out of 6,681 stores, 6,490 are franchised. That means franchises handle construction and operations, while Chagee supplies the ingredients, sets the tech and branding, and collects fees. In Q1 2025, franchise stores generated 92.8% of total revenue. This strategy allows Chagee to grow fast while keeping capital expenditure low. But there is a trade-off. Now that we have seen how the business is structured, let's look at how it performs in practice. Because the company owns only 191 stores, its balance sheet remains light on tangible assets. For investors, this means you're buying into a brand and a platform, not factories, not real estate, not machinery. If things go wrong, there is not much collateral left to fall back on. With Chagee's franchise-heavy model, revenue alone doesn't tell the full story. What truly reflects customer demand is GMV, gross merchandise value, the total value of products sold across the entire tea house network, including franchises. And between 2022 and 2024, GMV exploded. In 2022, total GMV stood at just 1.29 billion RMB. By 2023, it had jumped to 10.79 billion. That's nearly 9x growth in a single year. Then in 2024, Chagee reached a record, 29.46 billion RMB. But what's even more impressive is the average GMV per tea house. From 1.19 million RMB per stores in 2022, it rose to 3.07 million in 2023, then 4.57 million RMB in 2024. In other words, Chagee wasn't just opening more stores, each one was, on average, selling significantly more. Now let's look at the Q1 2025. GMV for the quarter hit 8.23 billion RMB, up 38% compared to Q1 2024. But the average monthly GMV per tea house in mainland China fell sharply, down to roughly 432,000 RMB per month versus 549,000 RMB a year earlier. That's a drop of more than 20% per store. But that's not just a function of new stores pulling down the average, it's deeper. According to the company, same-store GMV, that is sales from tea houses open for over 13 months, actually fell by nearly 19% in Q1 2025 compared to Q1 2024. In other words, even the older, more established stores are generating less than they did a year ago. So the growth in total GMV is clearly coming from new openings, not from stronger store-level performance. That doesn't negate the growth story, but it shifts the spotlight. Chagee will now need to show that it can maintain efficiency and profitability at scale, not just expand its footprint. And that brings us to another crucial indicator: operating margins. In 2022, Chagee was still in its early expansion phase, posting 492 million RMB in revenue, but 607 million RMB in operating expenses. The result? A negative operating margin of minus 23.6%, driven by high material costs and heavy administrative spending. In 2023, revenue surged to 4.64 billion RMB, and thanks to better cost absorption, the company swung to a 23.1% GAAP operating margin before interest and tax. That performance held steady in 2024, with 12.4 billion RMB in sales and 2.89 billion in operating profit, a margin of 23.3%. The turnaround was driven not by cost cuts, but by scale. Chagee's expenses grew, but revenues grew faster. And in Q1 2025, revenue rose 35% year-over-year, hitting 3.39 billion RMB. But operating expenses rose even faster, up 42%, especially in marketing, G&A, and company-owned store costs. Despite that, Chagee maintained a solid 24.2% margin, with 821 million RMB in operating income. A slight decline, but a sign that the model still holds for now. This is a high margin level compared to most other competitors in the tea and coffee space. Chagee is positioning as a global brand, but international sales are still tiny, around 2% of GMV in Q1 2025. As of Q1 2025, it operates 169 stores outside Greater China, mainly in Malaysia, Singapore, and Thailand. Since then, it had also entered Indonesia and the United States. In May 2025, the company launched its US flagship in Los Angeles. The opening drew attention, with over 5,000 drinks sold on day one. The design was praised, the vibe was sleek, the visuals were on point. But taste is another story. US reviews were mixed. While customers liked the experience, many found the drinks underwhelming. Too light, too subtle, not sweet enough. That's not surprising. Chagee's core appeal still seems to lie with consumers who are already familiar with Chinese tea culture. In Southeast Asia, especially Singapore and Malaysia, Chagee shows solid early traction, multiple new openings, and strong consumer familiarity, helped by a large Chinese diaspora and halal-certified operations. It's promising, but still early. Chagee isn't just selling tea, it's selling an experience. The company's product line is built around made-to-order drinks, using high-quality loose-leaf teas extracted with a proprietary Teaspresso system. The goal is clear: reposition Chinese tea as a modern, premium alternative to coffee. In Q1 2025, Chagee continued to push seasonal and functional innovation. One of the standout releases was the low-caffeine Boyati Latte, part of a broader low-caffeine product line designed for afternoon and evening consumption. According to the company, Boyana ranks third in terms of new customer conversion rates, and launch week GMV growth was notably higher in pilot cities. Another hit was the limited edition Longjing Spring Mountain tea, which accounted for over 16% of total cups sold during its brief seasonal window. It also posted one of the highest repurchase rates across the portfolio, suggesting not just curiosity, but strong consumer satisfaction. Beyond the drinks themselves, branding plays a central role in Chagee's strategy. For Valentine's Day, the company rolled out a rose-infused product line with customized packaging, which generated over 340 million impressions across digital platforms. According to third-party data, Chagee ranked first among premium tea brands in social media search volume and engagement in China during the quarter. This isn't a company chasing fads, it's using product innovation and aesthetic design to build a coherent, high-end brand universe. Stores are clean, minimalist, photogenic, and packaging is polished. Everything about Chagee is engineered to feel intentional, curated, and premium. The product may be tea, but the business is lifestyle. Now that we have seen how Chagee grows and sells, let's focus on what shareholders get in return, starting with earnings. Let's talk about net profit and earnings per share, because they are not the same thing. 2022 was loss-making. EPS landed at minus 1.45 RMB, with preferred share accretion and cumulative undeclared dividends further dragging down what common shareholders received. In 2023, net income was 802.6 million RMB, and the basic EPS came out at 5.04 RMB. In 2024, net income jumped to 2.51 billion RMB, but the EPS, after all adjustment, was 14.26 RMB. Bottom line, EPS is not just net income divided by total shares, it's what's left after everyone else gets paid. In the first quarter of 2025, Chagee posted a net income of 677 million RMB, up 13.8% year-over-year. But what really matters to shareholders is EPS, and here the picture improved too. The basic EPS came in at 3.92 RMB compared to 3.32 RMB a year earlier. Even after factoring in preferred share accretion and undeclared dividends, earnings per share increased, reflecting stronger operational leverage and a better allocation of profit to common shareholders. Let's now move from earnings to the balance sheet and examine how Chagee's financial structure supports its growth. Chagee's balance sheet tells a very clear story: strong cash, minimal debt, and almost no financial risk. In 2022, financial debt wasn't disclosed, but based on the available data, it was likely close to zero. The company held 200 million RMB in cash, resulting in a net cash position. In 2023, cash jumped to 2.32 billion RMB, while financial debt, composed exclusively of lease liabilities, stood at 109 million RMB. In 2024, the pattern continued. Cash doubled to 4.75 billion, and lease debt rose modestly to 548 million. That left Chagee with over 4.2 billion RMB in net cash at year-end. But there's one thing the 2024 numbers don't show. Chagee went public in April 2025, raising $472.9 million. And that capital boost is not included in the reported cash position at March 31. As of March 31, just days before the IPO, the company's treasury stood at 5.39 billion RMB, showing strong cash flow from operations. That figure still excludes the IPO proceeds. Bottom line, Chagee's financial structure is ultra-solid. No bank debt, modest lease obligation, and a growing cash pile soon boosted by its IPO. That gives the group maximum flexibility to fund its international expansion without taking on risk. Beyond the balance sheet, there's another critical element to assess. How much real cash is the business generating? Beyond profits, what really matters is cash, and Chagee has been building it fast. In 2022, free cash flow was minimal, just 32 million RMB. But by 2023, it had soared to nearly 1.9 billion RMB, and then to 2.6 billion in 2024. More importantly, free cash flow per share went from 0.32 RMB in 2022 to nearly 26 RMB just 2 years later. That means Chagee isn't just reporting profits, it's turning them into real, bankable cash. This internal cash generation gives the company strategic flexibility and reduces reliance on debt or equity dilution to fund growth. But how does the market value all this? Let's take a look at Chagee's current valuation. Chagee is still a newcomer to the stock market. The IPO took place in April 2025, which means there is a limited long-term price history to work with. But since its debut, one thing is clear. The stock has been in a clear downward trend, with early enthusiasm quickly fading. The company doesn't pay any dividends and has no plan to do so in the near future. Management is fully focused on aggressive expansion, both in China and internationally. That said, when we look at valuation, the numbers look surprisingly low. Based on its 2024 results, Chagee was trading at around 11 times earnings, already a relatively low multiple for a high-growth consumer brand. But when adjusted for more recent performance, using the trading EPS that replaces Q1 2024 with Q1 2025, the implied P/E ratio drops even further, to around 10. Here is how Chagee stacks up against its key competitors in tea and coffee. So where does that leave Chagee? It's a promising consumer brand with rapid growth, strong margins, and clean balance sheet. But it's also a company with multiple risk factors that investors shouldn't ignore. There is no real moat, no cultural stickiness outside of certain cities or regions. Its business model is almost entirely franchise-based, meaning shareholders don't own much beyond the brand and the platform. And all of this plays out in an ultra-fragmented, fiercely competitive drinks market. Despite the sleek branding, the international rollout remains tricky. Early US feedback has been mixed, with some finding the flavors more subtle than expected. In Southeast Asia, especially Singapore and Malaysia, Chagee shows solid early traction, supported by consumer familiarity in both markets. Beyond that, product market fit is still unproven, and international sales remains a tiny share of the group's total. Then, there is the lack of shareholder returns. No dividends, no buybacks. And while current profits are reinvested into growth, there is no clarity on what the capital allocation policy will be once the growth phase slows down. Some companies like Baidu never really became shareholder-friendly. And let's not forget the charts. The post-IPO trend is clearly downward. That raises the question, is the market pricing in a collapse in fundamentals? And yet, on fundamentals, the setup looks appealing. At around 10x earnings, with solid free cash flow and a debt-free balance sheet, the current price may offer a compelling entry point. In fact, among its key competitors, Luckin, Mitsui, Starbucks, Guoming and Auntie Jenny, Chagee currently trades at the lowest PE multiple. That disconnect between fundamentals and valuation deserves attention. And even if growth is slowing, the underlying market for freshly brewed tea is still expected to expand over the next few years, just at a more moderate pace than before. Personally, I think it's a case where taking a small position makes sense, but with a clear understanding that this is speculative and highly volatile. We'll get more visibility with Q2 results, but by then, the current price opportunity may be gone. So for now, I will take an initial stake and consider topping up based on valuation and how the business delivers. Thanks for watching this deep dive until the end. If you found this analysis useful, feel free to like, subscribe and share this video. And let me know in the comments what company you'd like me to cover next. And if you are into tea brands, you might also enjoy my video on Yili Group, China's leading dairy company and a major supplier behind many other milk-based drinks in this market.